This is Dale. One of the common comments I get on my videos is, yeah, credit spreads. I've heard credit spreads are pretty risky because you can have a high percentage of wins, but when you lose one, you can lose everything you've gained. And that is the truth. That is the truth. But you have to learn how to manage these credit spreads. Now, I've been doing this for over 4 decades, and this is how I've made my living. So I know how to manage these credit spreads. And yes, indeed, you can't let them get away from you. So I've got a number of rules that I put in place that if I see a trade go against me, I don't try to adjust. I don't try to correct it. I just get out. And if you have those rules in place, even with a catastrophic drop, you can get out and not see this huge loss. So I want to show you what I do and what I've been doing and what I teach the people that come into my webinars. Very important concept, very important concept. I love credit spreads. I think they're the best, most conservative investment vehicle, especially for the retail investor. You're basically selling an option out of the money and you're buying one further out of the money. It's very easy to put on. I can show you exactly how you put that trade on, how to execute it. You get great returns coupled with a very high probability approach to the price action. It yields monthly income on a consistent basis. Do I have all winners? No. Do I have losing streaks? Yes. Yes, but over the long haul, I do very, very well. And I'll show you the equity curve for the last 2+ years towards the end. Now, with credit spreads, you're basically selling premium. So think about going to the casino. Who wins at the casino? Not the person coming in there playing craps and roulette and so forth. It's the house. The house wins because they have an edge. They have an edge. Well, we're basically the house when you sell a credit spread because we're selling the premium to somebody who is buying that thinking that the price of the stock is going to go in one direction or the other. With credit spreads, you don't have to constantly watch the market. I check the market a couple times during the day, but I don't even watch it all the time, and I don't want you to either. So this is a method that you can put this on, and if you just take a look at it every once in a while, you're going to be fine. It is a low anxiety trade, and like I said, when you sell one, you're going to buy one an option further out of the money to protect yourself from losses. Now let's just take a look at a bear call. There's two ways of putting on credit spreads. If you think that the underlying stock is going to be going down, you want to put on a bear call spread. That's a bear. The operative word there is bear. This is a bearish strategy. Just the opposite is true for a bull put. In both of these, in the bear call, you are selling a call, and then you're buying one further out of the money. So this is just a chart. You can see the price. This I think was Amazon. The price is going down. I wanted to put on a bear call right here for a number of reasons. One, the 5-day exponential moving average line crossed the 20, and the price hit the 20-day. That's a big indication that you're probably going to drop. But you can see that the bear call I placed was very conservative, way out of the money. Now with credit spreads, you can profit when it goes in the direction you think, if it goes sideways or if it goes up a little bit, as long as it doesn't get into this region. The price when I did this was right around $98, and I sold the 115 strike. How did I determine that? I usually just, very easy, I just look at a delta of 0.2. Delta of 0.2 is where I sell the strike. And then I bought the 125 out of the money. This gave me a net credit of $1.50. And I had a 10-point spread. So the risk was $10 minus the credit of $1.50, or the risk was $8.50. Now, if it goes against you and this goes all the way up and up into this area, yes, you're going to lose $8.50. It's a risk reward ratio of almost 6-to-1. Ouch, that's what people are afraid of. That's what people are afraid of, and rightly so. The credit did have a high probability of about 80%. However, if you won 80% and lost 20% with a 6-to-1 ratio, the losing ratio, you could expect to lose about $50 per trade per contract. Now let's take a look at this equation that was taught to me many years ago by a floor trader. This is, you take the profitable percentage times how much you can make when you win, minus the losing percentage times how much will you lose, or how much you have risked. So here we have 80% profit times $1.50, okay, minus only 20%, but times $8.50. And what this shows you is you're going to lose $50 per contract per trade, okay, and that's not a positive expectation trading strategy, and that is a loser. That is a loser. Okay, so with risk management, if the trade goes against me, I exit looking at two things. When the 5-day exponential moving average line crosses either over, if I'm looking at a bear call, if it crosses over the 8-day, or if I'm looking at a bull put, if it crosses under the 8-day, then the trade has gone against me. And yes, indeed, sometimes the best analysis, the trades are going to go against you. That is a hard exit for me. Or I use a risk profile to exit at 6% of margin. Now, how did I determine that? Like I said, I've been doing this for many years. And it's the combination of these two, really. If I see that the 5 crosses the 8 and we're close to the 6% of margin, that is get out, okay? This risk profile basically shows you this is the risk profile for a bear call, and this is the max you can lose, okay? And then this is the max you can gain. Well, you can see that, yes, indeed, you can lose a lot more than you gain. Now, this purple line is what it's priced today. What I do is I come in here and I put in a line at 6% of margin, and that's when I want to get out. That's my uncle point, if you will. And then I put in a line at about 10% of margin, and that's when I'm totally fine with taking that profit and getting out, okay? So I watch this closely. Well, when I say closely, I said you don't have to chart hawk. Every couple of days you come in and just take a peek at the risk profile. As long as you're to the right of the 6%, just let this trade go. Just let it go, let it evolve, okay? Gets close to these two things, you probably want to watch it on a more frequent basis. Hits both of these two things, out, you exit. Don't even think about it, you exit. Okay, if I do that, and I have done this for many years, and I've got, you can actually, on the website, you can look, as a member, you can look at all the trades I've publicly released for the last 12 years. And you can see that I win 75% of the time. 75% of the time I win. An average win is about $100 per contract, okay? So therefore, I lose 25% of the time. But by using the two rules that I just showed you, I can minimize the loss from 850 down to 60. This comes out to show a positive $60 per trade per contract. And a lot of my people trade multiple contracts. If you had 10 contracts, you're looking at a $600 profit. If you had 50, you're looking at $3,000 per trade. So this is a very, very powerful strategy. This is my equity curve since January of 2020. And you can see that if with a positive expectation trading strategy and an equity curve that just goes right along, very consistent monthly profits. Yes, indeed, we do have losers. We do have losing streaks. This actually was a losing month. I think it was actually a losing month and a half, close to 2 months. This was when the second bout of coronavirus came out, and also Russia invaded Ukraine, and the Feds were scrambling and increasing interest rates, and the market hates indecision, and I couldn't get on the bearish side quick enough, and I lost some trades there. But this is the kind of equity curve you can expect if you join me. So the question is it possible for you to be a success allowing me to do all the work? Yes, it is. I've shown you the exceptional ROI. I don't release a lot of trades, but the ones I do release are my very best. This is for new traders. If you don't know anything about stock market, about options, I can teach you. The strategy is, as a matter of fact, some of my best students are the ones that don't know anything when they come in, because they're fresh, and I can give them ideas and show them a strategy, and they don't second guess it. But this is great for the experienced trader as well. It's good for an individual with a small portfolio or large. It's a matter of a number of contracts. And what I do is I send out alerts. I follow financially strong stocks. It's a portfolio of about 15, 20. And then I follow the SPX and the SPY. This is a great service, and I get a big kick out of doing this right now. This is what I I've been there, done that basically, and I don't teach because I don't do. I have done, but I want to teach people how to do this, because if you learn how to do this, you can pass this on to your son and daughter, your grandchildren, whoever. And then I have to mention that 10% of all profits is donated to local food cover, where I serve on the board and I'm a volunteer. I'd love to have you be a member. So go into www.optionsinfinity.com, www.optionsinfinity.com. There on the website, you'll be able to see some blogs that I've put on before, some results, some testimonials, and that's where you can sign up. I hope to see you in the room, and I hope you all enjoyed this video. And don't be afraid of credit spreads. If you manage your risk, you're going to do just fine. Bye-bye now.